diversification. Second is asset allocation. Third is dollar cost averaging. And fourth is portfolio rebalancing. So let's talk about asset allocation. Asset allocation is, it's proven, studies have been done, that asset allocation is the single most important determinant of your portfolio's returns. So, you know, if you Google asset allocation or if you Google diversification, what you're going to find is a whole lot of people write about diversification and asset allocation in the same sentence, in the same article, in the same context, but they're really two different things. One is very simple, straightforward. It's just not putting all your eggs in one basket. It's diversifying. But asset allocation, which today most people, when they say diversification, they're talking about asset allocation. But it's really, it requires that you understand a few things about asset classes. So I'm just going to name off a few asset classes, because for you to understand the power and the importance of asset allocation in terms of an investment strategy, you really need to understand what is an asset class. So if we were in person in class, I would just start asking questions. We'd start having conversation, and we would, sorry, I saw a chat. I thought it was a question. So if we were in person, I would start asking questions, and I would find out what you know about asset allocation. So I'm going to ask you to, if you know a little bit about asset allocation or asset classes, just tell me what you know in the chat box. I'm going to start naming off some asset classes, and I'm going to describe them a little bit and try to help you understand how they work together over time in terms of a portfolio. So the first asset class I think of is large cap. Anybody know what large cap is? And then if you think large cap, the next thing you would think is, okay, what's the opposite of large cap? Small cap. And then what's in the middle? Mid cap. So does anybody have a clue what large, small, mid, what those asset classes might look like? So I'll come back to that. But that's equity investing asset classes. And you could invest in an individual stock like Apple, or you could invest in an index, like you could invest in a mutual fund, an index fund, or an ETF. Those are types of investments. They're not actual, well, they're types of investments, but mutual funds, there's a whole bunch of different kinds of mutual funds. And they could all be different, investing in different asset classes. So you can invest in a mutual fund that's focus is large cap stocks. Or you can invest in an index fund, which focuses the S&P 500 or the Dow or the NASDAQ. So you can invest in a mutual fund and get diversification that way by paying a manager to pick stocks in any asset class. Or you can invest in an index fund where you're just buying an investment that replicates or acts like a proxy for an index, like the S&P 500. I keep mentioning the S&P 500, and I suspect some of you don't know what the S&P 500 is because nobody's posted a comment in the chat. So I better take a minute and start with the S&P 500. So the S&P 500 is the Standard & Poor's 500. It's the 500 largest U.S. companies on the planet. So if you invested in something that was a proxy or replicated the performance of the S&P 500, you would be investing in a fund, mutual fund, an index fund, or an ETF, exchange traded fund. You could be investing in that whole list of companies with one investment in one asset class. Does that make sense? So that's like the basic building block of asset allocation. Thank you, Monica. I'm glad that makes sense. So the S&P 500 are the large companies. Think of the largest companies. Like right now, the S&P 500, 40% of the value of the S&P 500 comes from 5 stocks. Microsoft, Apple, Amazon, Google, and Netflix, I believe. Maybe Facebook too, so maybe 6 stocks. But think about that. With 500 companies and the stock market's huge rise since COVID hit is based on only 6 companies. 40% of the value of that index is based on just 6 companies. That scares me, because when you talk about asset allocation and diversification, you're starting to see something here that hopefully you understand is a little bit risky. Yes, the S&P 500, if you look at a chart, and I'll post you some charts and some videos that I'll work on. In fact, I might post charts when I do this. When I post this video, I might overlay it with some charts, but I'm not going to do that while I'm telling the stories. But the S&P 500, it goes up, 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 and then it comes down, down. And if you look at that chart, and I'll show you that chart. In fact, I'll pretend that chart's right up there, and you'll see it. I'll share it. But it's a chart, and it goes up and down. And that's okay, because I'm going to teach you how to use these strategies to make money over your lifetime. But you need to understand that large cap stocks right now, they've just gone up, 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 up. And they're very likely to go down, 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 and then back up, up, up. And over time, they go up. Over time, equities go up. Large cap is large companies. Small cap is small companies. Which companies do you think have more risk? Large established companies or small startup companies? Which one has more risk? Small. I see some people saying, why do you say smallies? Why small? Why? It's not a difficult trick question. It's very simple. Small companies are risky. A lot of small companies go out of business. And yeah, they go public. You can trade their stock, but they may start out as a penny stock or $1 or whatever. They're just small companies, and they have a lot of risk. So because they probably can't borrow as much or aren't as diversified. That's exactly right. Now, that's inside baseball right there. But the truth is, small companies don't have access to capital like big companies, big established companies. That's one reason that I'm not going to get into macroeconomics here, but if you don't know what a zombie company is, just for your own benefit, you might want to know what that is. It has to do with capital and debt. So we talk about stock and equity asset classes, large cap, small cap, mid cap, it's right in the middle. Less risky than a small cap, more risky than a large cap, but it's an asset class. And then on the other side of that, on the opposite side of equities, you have bonds. And I posted some videos and some content to help you understand the difference between an equity and a bond. And I'm not going to go into that except to say that they're two different asset classes. And typically when one goes up, the other one goes down, which is one of the things that's really helpful about asset allocation. When you do it right, one asset class goes up and the other one goes down, and they generally are not correlated. Now, none of them are perfectly correlated or perfectly uncorrelated, but that's part of the magic, if you will, of asset allocation in terms of a risk management strategy and a strategy to maximize returns. It's really important. Asset allocation is all about asset classes. So you've got large cap, small cap, mid cap. You got bonds, and you got government bonds, you got corporate bonds, two different asset classes under the same category called bonds. And if you don't know the difference between a bond and an equity, it's because you didn't do your homework. You didn't watch the video and understand, and you need to go back and do that, because it won't make sense to you, and it won't give you the insight that you need to be like Angela or Andrea Smart, the smartest investor. She understood, and so she did a great job of allocating assets across different asset classes in all of her investments, in all of her accounts, in a way that made her outcome really, really good. And I'm going to tell you more stories about Andrea Smart, because she kind of set the table for me early in my career as like the paradigm for, man, I want to invest like her. I want to teach other people to invest like her. She was really smart, still is, very successful. So asset allocation is key. So you got bonds, you got corporate bonds, you got municipal bonds, you got government bonds. Those are all different asset classes with different, they do different things. And this course and this lesson, this story isn't to teach you all the ins and outs of an asset class, but it is to help you understand that this one investment strategy called asset allocation, it's critical to understand that it's all about asset classes, mixing them and configuring them in a way that gives your portfolio the best chances to perform well and to manage risk. So you got equities, you got stocks, you got bonds. Stocks, large, small, mid, bonds, government, corporate, municipal. But then you have a whole nother branch, which is international or emerging markets. So you could invest in Japan, you could invest in Europe, you could invest in Russia. Those would all be a whole nother class. That could be an emerging market with a large company, emerging market with small company, emerging market with a micro company. I mean, there's all kinds of asset classes. And I'm not saying you should be investing in every asset class, because you can't, you wouldn't want to. But you should be diversifying and spreading out and allocating your asset classes depending on how much wealth you have to invest. You want to, spread it out in a strategic way. That's called asset allocation. And there is no more important strategy for you to understand the basics of than asset allocation, because it's the number one determinant of your portfolio's returns. So here's the bottom line. We go back to the perfect investment. Day number one, you're asked, you got your perfect job. Let's pretend you're making $100,000 to keep the math simple, and you get an 8% match. How much does that mean you have to put into your 401k in order to receive that perfect investment opportunity? 8% of 100,000, remember, it's $8,000, which means if you're getting an 8% match, you have to commit to put 8,000 of your salary into your 401k, which means day one, when you're sitting down with HR and they give you the form, you say, yes, I want to participate in the 401k. How much do you want to participate? You're going to do a little math and you're going to figure out, if you get paid twice a month, how much is that to be deducted from your paycheck to go into that account? How much should that be to equal $8,000 in a year? Simple math. You're going to make that calculation. You're going to put that number down because you want to at least commit to the $8,000 a year. If you're getting an 8% match and you're making $100,000 a year, that's $8,000. That's what you want to invest. You could do more, but absolutely don't leave that on the table. Don't leave the match on the table, because you put $8,000 in. Number one, you put $8,000 in. Number two, they put $8,000 in your account. So you just doubled your investment. There's no better investment. It's the perfect investment. If you have the opportunity, number one, you put the match in, the total amount. Number two, they match it. And number three, another three reasons, well, the third thing I want you to know about the perfect investment is, if you make $100,000 and you put $8,000 into your 401k, then you basically get an $8,000 tax deduction, which means the IRS looks at your tax return and they say, instead of you making $100,000, you only made $92,000, which means you only pay tax on $92,000. So the tax deferred, tax deductible benefit of your 401k is tremendous. And now you get to the next question on that form. It's like, okay, you're going to put $8,000 a year in and we're going to match it. Where do you want to invest that money? And before you took this course, about half of you would have said, I want to invest it in my 401k, or I want to invest it in my Roth IRA, or I want to invest it in my IRA. But those are not, or my brokerage account. Those are types of accounts. They're not investments. So now on that form, you have to look at what your options are, and what you're going to see is going to be really cool. You're going to be like, oh, I remember now. Professor Munchback was talking about this. You're going to say, I want to put some in large cap, small cap, international, and bonds. And maybe that's the only four options you get, is large cap, small cap, bonds, international. And that'd be okay. You could do 25% in each and you'd be just fine. You don't have to get it perfect. Some of you are going to be smart enough to know how to allocate that a little differently. And you may have way more options than just 4. But that's the basics of asset allocation, and you need to understand it well enough so that day one, when you're sitting down with HR, you can take advantage of the perfect investment in a way that's going to make your money do a lot better for you than if you just put it in the money market. That's like putting it in your checking account. And some of you did that with your $1 million, and you're going to fix that for your capstone assignment because you're going to see how that moves the needle to do proper asset allocation instead of just putting it in your checking account. It's going to move the needle for you tremendously. And if you learn that and understand that, and you apply the basic lesson of asset allocation to your portfolio over your investing life, I'm telling you, it's going to make a huge difference in the outcome. It's going to make it super easy for you to become a millionaire by the time you're 50, or maybe a lot sooner. Okay, let's see. All right, so we've covered 2 of the 4 investment strategies that are designed to maximize return and minimize risk. First one is diversification. The second one's asset allocation. The third one is dollar cost averaging. And the fourth one is portfolio rebalancing. So I told you about Bill, the company man who passed, went through tremendous anxiety because he really, truly, I mean, there's no question in my mind that his death and his shortened life was a result of bad financial choices. He failed to diversify and he went down with Enron. Terrible tragedy. Unfortunate for his widow. She survives, but barely. And I mean, barely financially. So that's the first story, diversification. The second is asset allocation. And it's really a story about different types of asset classes. And every wise investor knows about asset allocation, and you need to as well. It's easy to find more information on it. So I would encourage you to just get familiar with it, put it on your radar, pay attention to it. The third investment strategy that is designed to maximize your return and minimize your risk is it's really my favorite strategy. It's called dollar cost averaging. And so